recent changes in the portfolio. If I look at the calendar year 2020, we've sold £160 million of assets, 3 retail and leisure, 1 office and 1 industrial property, assets that we didn't think had the right future performance attributes, and purchased or committed to £74 million worth of assets, 3 investments, 2 student fundings due to open in the year 2022-23, and 1 supermarket at the end of 2020. Carrying on from there, in Q1 up to 31st March 2021, we've made some further sales. 1 really exciting sale of a retail park in Kew, which we sold a good price to a UK house builder, taking advantage of the appetite for areas that had the potential for conversion to residential, and an office in Sheffield. Looking at all of that together at 31st of March, the portfolio comprises 62% exposure to the industrial sector. That's been a real driver of performance, and I believe set to continue driving performance. Retail, continuing a longer term theme, very low exposure to retail at 11% of our portfolio. Offices, again, low. Some years ago, we sold out of the West End. We only have 1 office in the West End left, and one of our sales last year was the sale of our remaining City of London office. So offices down to 15% exposure, and almost the entirety of that in the southeast and the regions outside of London. I think London, and in fact offices altogether, have quite a high degree of risk around them as people adapt and businesses work out how they're going to reuse offices. I think they will be used, but I think polarization, which could apply to virtually all these sectors, is very, very relevant in the office sector, with very modern, well-located, near transport hub offices winning over poorer quality. So reflecting that risk, we have a low exposure in the office sector, and we have a balance of 12% in the alternative sector, growing with the student schemes that we have added. All in all, we have 35 assets, so a good spread of assets, diversified across sector, strong tilt towards industrial, but diversified geographically by sector and by tenant. Relatively concentrated portfolio of assets that I believe in. Within that, we have over 180 tenants, and again, just picking out in our top tenant list by rent, we have Ocado, Amazon, B&Q, the government. So a good tenant list and a diversified tenant base. Our NAV total return for the 12 months to 31st March 2021 has been 4.2%. And I like to think of the engine room of NAV as the twin impacts of the portfolio total return, the direct property total return, and also the impact of gearing. So we have low gearing, around 6%, just below 6% net gearing in the portfolio at the moment. In terms of portfolio total return, a really strong last 12 months, 5.6%, playing our MSCI property benchmark of 2%, so good outperformance. In fact, up to 31st March, we've outperformed since inception of the trust in 2006, over 5 years, 3 years, 1 year, and indeed the last quarter. So the portfolio doing well there, and that's been driven in recent times by the tilt over 5 years into the industrial sector, the weight of that industrial return, not just the weight of it or the volume of money we hold in industrial, but also the quality. So for instance, over the last 12 months, UKCM's industrial portfolio outperforming the benchmark and then doubling up, if you like, by the volume of money in that sector. And when thinking about performance, and included in these figures is our experience on rent collection. So what perhaps rather harshly I refer to as the COVID year. So rent collected, looking forwards from March 20, June 20, September 20, December 20, we collected 86% of rent, and of that missing rent, we're still there. We're still speaking to tenants. We have rent coming in, but that 86 rent collection was far higher in the industrial and office sectors, lower in retail and leisure, as you might expect. And again, for Q1 this year, so this is March, renting forward, we're at 86% again. Quarter on quarter, we've been growing, and our aim is clearly to improve. Before COVID, we were collecting 99% more or less of our rent. So working to get back to higher levels of collection. I'd also like to talk about dividend. The board and our investment team hold shareholders and stakeholders at the heart of what we do. COVID 2020 was a difficult time for many parts of the market, and we were pleased that we maintained and continued to pay the dividend throughout 2020. We were looking carefully at rent flows, risk to rent flows, and how that's evolved. The end of 2020, we were able to announce a fifth additional top-up dividend to that which we paid in 2020. And most recently, our most recent NAV announcement, we indicated a 40% increase on our previous level, 2020 COVID dividend. So growing dividend there, which I was pleased to see, and also with the prospects for earnings growth to come. We have £268 million, 31st March, capital available for investment. 150 million of that is held as undrawn debt with our revolving credit facility. But we have that potential to invest and to grow earnings. And the trick is to make sure that money is invested, not just spent. Very easy to go out and spend that money tomorrow, but as we have been doing, to invest it carefully to the benefit of shareholders. Yes, let me try and bring two holdings to life. I'm going to choose an asset in the industrial sector and an asset in the alternative sector. Looking at industrial, I just find it so exciting what is happening in and around London at the moment, with low supply of land, rents moving ahead, and one of the monopoly board, if you think of monopoly board and the railway station points to the compass north, south, east, west, we have industrial estates in all of those locations. Radlett to the north on the N25, Gatwick to the south, Dartford to the east, and Sunbury-on-Thames to the west. Sunbury-on-Thames, quite close to Heathrow, an industrial estate with really quite diverse bunch of tenants. And I find what they do very interesting. We have a bonded warehouse, a self-storage facility, and more recently a Chinese importer having come in there. They value the proximity to Heathrow and the proximity to get into London. And we've just seen really, really strong rental growth from an interesting. The second asset is actually our newest addition, the funding of a student scheme in Edinburgh. We've recently committed to two student fundings, one in Exeter, one in Edinburgh, both with similar characteristics, but just thinking about the most recent in Edinburgh and Gilmore Place. And for anyone that knows Edinburgh, Edinburgh University is a top 30 global university, really strong in the UK. And the really exciting thing about the asset that we're developing is the location of it. Really, really easy to get to Edinburgh University, and indeed Heriot Watt to Edinburgh University. Really easy, attractive walk, very safe environment. In terms of specification, it's a combination of restoring a listed building with two new wings being added. So specification great, good ESG credentials with ground source air heat pumps, and that's valuable for student demand, very switched on to ESG. And the other thing about the specification, 90% of the rooms being of a cluster variety, which is really popular with students, and we set to continue to be. So I'm looking forward to that opening in 2022, and I think demand will be really strong. Themes for the trust really fit with our strategy, that strategy of having a portfolio which represents property fit for the future, taking account of demographic, technological changes, and working in a modern economy. Those assets that businesses, companies want and need to occupy and can make a profit from, pay us good rent. Within that, a large proportion of the portfolio I see as being in the goods and services distribution sector. And again, a large part of that is industrial and distribution. That's done well. With our research, I believe it's set to continue to do well, not just in the short term, but a longer term theme. And again, back the experience I've had often these themes do take many years to play out. So Brexit is helping there in that goods and services distribution space, an increase in stockpiling, shortening of supply lines, lack of supply, particularly in urban areas. So that's a theme we'll hold a reasonable exposure of goods and services distribution stock, perhaps wider than just the industrial sector there. And we'll add to that some higher yielding assets as well. We have those already. I've mentioned the development of 2 student schemes that we're funding, and I'm also looking with the capital that we have available very selectively in parts of the retail warehouse market. Retail as an overall sector has a lot of risk, very polarized, but parts of it I think show signs of a really interesting sustainable income, particularly convenience-led and food in that out-of-town retail sector, but critically where rents are right or have been rebased, set low, and the size of the units, the configuration is again fit for a modern economy, fit for the future.